I am really happy to be speaking today about something so important, and that is investing in uncertain times, using stocks and bonds to secure a financial future. We're going to be going through about 30-some slides with a lot of information. But the good news is that we're recording this. So you can listen to it again because you're going to be walking away with the tactics you can use to shore up your portfolio and make sure that you have the best investments possible to get you on your path to a secure financial future. So we're going to be jumping through this, and the first piece that we're going to do is we're going to talk about financial resiliency, what it is and how you can bring it into your life. And the time of COVID-19, I think that we can all agree how important financial resiliency really is. We're going to then talk about financial immunity and retirement planning, so how you can protect your portfolio from whatever the economy, your life, or the stock market throws at you. And how are we going to do that? By picking the right stocks and bonds, and we're going to give you the tools to be able to do in-depth analysis so that you can be assured that the way you're investing and the types of investments you have are the best investments for you. And then, of course, any questions. And you have a chat on the side, so feel free to use that of any questions that you might have. And you can put the questions in while we are going through all of this information. I think that would be great because it will help me in that point in time be able to further explain. And what I do promise to do for you is I'm going to promise to try not to use technical jargon. Because technical jargon, at least for me when I go to the doctor and he or she is using technical jargon, I find it overwhelming. And to be honest, I find it to be a little frightening. And so that is my promise to you. I'm going to be trying to talk to you as your girlfriend and make this a fantastic and fun time that we have together. So financial resiliency is being able to bounce back from a financial challenge. And I think that many of us have had some type of financial challenge. In fact, 1 out of 4 people in America have seen their incomes decrease substantially during the pandemic. So that's definitely a situation where financial resiliency is important. And resiliency is also important for your portfolio. And I included this slide because I thought it was really, really powerful and key. And it looks at income shocks. It looks at income shocks, drops in your income due to maybe a layoff, being furloughed, illness, or another life event. And when you get to the age 66 to 70, that age range, you see that 96% of individuals, almost everyone in that age range at some time in their life, live through a drop of 10% in any 1 year. In fact, they live through that 10 times. And 93% of those individuals in that age bracket of 66 to 70 have gone for more than a year without earning anything during their working career. So I don't know where you are in this bucket of different age ranges, but I encourage you to look at your bucket. And so for me, I'm age 35 to 54, and 78% of people in my group have had a drop of 10% or more at least 4 times. Guess what? I'm one of those people. Gone for a year without earning any dollars? Well, that 56, I am one of those people too. And that is when I started Savvy Ladies and when I started Francis Financial. In fact, to be honest, it was many years. So how do you protect yourself? Well, we're going to be going through these, but here are the top smart moves. Tracking your spending. People who track their spending and know where their money goes make conscious decisions about their spending, and they also tend to spend more wisely and less. Cut your costs where you can, and this is actually really important and key in the time of COVID. We've all learned what we can live without. And it's interesting because I had my first cappuccino 2 weeks ago, and I had not had a cappuccino since February 2020. And I will tell you, in all honesty, that cappuccino was fantastic. I was so excited. I felt like a princess, $1,000,000. But I also realized that I don't need to buy myself a cappuccino every day to make myself happy. Because guess what? I existed, how many days is that? Well, not quite a year, but not far off of not having any cappuccino. But don't worry, I had lots of coffee. The other thing you really want to do is to build your emergency fund, and that's 3 to 6 months of your living expenses. What saved me as I built Savvy Ladies and Francis Financial with no income is that I had built up an unbelievably robust emergency fund, because I knew that starting a business and a charity was not something that was going to be able to pay me, at least in the short term. Getting rid of high interest debt, and I will tell you, Visa, American Express, MasterCard, they are not your friends, and every dollar of interest goes towards these huge conglomerates that don't care about you. They see you as a dollar sign. So as fast as you can to pay off that interest and pay off your credit cards, the better and more sound a financial future you're going to have. Now, we're going to talk about refinancing options. A lot of people are refinancing their mortgage, and if you have a rate that's above 3%, most likely you are a candidate to refinance. Take a look at that. Review your property and casualty insurance. That's a fancy way of saying your renter's insurance, your auto insurance, and your homeowner. It could be that you're paying for things that you don't have. For example, I found that I was paying for a necklace, a jewelry necklace, and insuring it that actually I don't have anymore. And I was paying something like $20 a year for that. Review your insurances, that if God forbid something does happen, that you'll be okay, that you have the right disability insurance in place if you can't work, that you have long-term care insurance. And I know that this is a lot of information. We have specific seminars on these topics and more at Savvy Ladies. So definitely visit under the Wednesday Wisdom series, and you'll see fantastic seminars that we've given on life insurance and disability, as well as seminars that are devoted totally to long-term care. But these are the essentially greatest hits of how you can, again, be as financially resilient as possible. So we're going to talk about these credit cards again, because they are sucking your wallet dry. And the top thing you should be doing is to try to make as many payments as you can, in particular to be able to pay off the highest interest rate. Now, you may be in a situation where you can't make payments. So what you can do is take control back from these conglomerates. Give them a call and ask them to lower your interest rate, to waive late fees. And many companies have great announcements on their websites that allow you to, again, lengthen their payment terms. There are a lot of things you can do. Worst comes to worst, grab one of those offers that you might be getting in the mail or email for a 0% credit card and threaten them that you will roll over this to that 0% credit card. We find that 50% of the calls actually go through to either reduce the interest rate or to be able to waive late fees. They don't want to lose your business. So make sure that you're looking at that and making sure that you're reducing your interest rate as much as possible. If you do roll over to that new credit card and you decide you're going to move to that 0% credit card, I want you to know two really important things that are in the fine print that you need nearly a magnifying glass to read. Number one, the rollover to the 0% card typically is not free. Often there's a fee of about 1% of the balance that you have to pay. So make sure you read through those fine lines and know exactly what it's going to cost you to roll over to that 0%. The second thing is that if you're opening up that new card, it's going to impact your credit. Your credit is going to see a temporary hit. Now, not forever, and maybe it actually might be worth it for you because your credit will recover, typically in a few months or maybe a little bit later, but it will recover. But again, know and be an informed consumer when you're going about this. Mortgage payments. If you're having a difficult time making mortgage payments, New York has put into place coronavirus relief measures that allow you to request 180-day forbearance on essentially not having to pay your mortgage. And also, they're working on halting both evictions and foreclosures. Now, should you do this if you have the money to pay your mortgage? The answer is no. Make sure you are paying your mortgage if you do have the money, because it will impact your credit and it will make it harder to refinance and get another mortgage in the future. Student loans can be strangling. In fact, we see now that people graduating university have tens of thousands of student loans. If you went on to graduate school, it can be upwards of 6 figures in student loans. The good news is that student loan interest will be waived through September 2021. So that you had last year. However, you can also request a deferment, or what you call a forbearance, if you're having financial difficulties. So reach out to your student loan provider to get the details and know what options you have. Unemployment insurance. This is key and extremely important. If you have been furloughed, if you're not working, also this covers individuals who might have a small business who are not able to earn their income as they normally would. Unemployment has been greatly broadened to include so many more people to be able to collect that couldn't necessarily collect before. I included the Department of Labor's website here on the right so you can go and see what that looks like. If you are unemployed, make sure that you file the first week that you lose your job. It's really important. And also know that you are entitled to that unemployment payment, because you may not have realized this, but you actually and your employer pay unemployment insurance. So you very much are entitled to this. So make sure, again, that you file for that. So we just talked a little bit about being able to rebound from financial challenges that get thrown at us. Now I want to talk about how we can protect ourselves going forward. Because something that we can all agree on is that the world we live in today is pretty darn uncertain. And when it comes to investing, the most important thing is to think long term. And ladies, I want to tell you this. Your investment time horizon, that means how long you have for your portfolio to be invested till your age of death, it's a lot longer than you actually really think. For most of us, we're going to be living out to age 95. So most likely our portfolio is going to be invested for another 30 years or more. And know that you're going to see your investment portfolio go up and go down. And if you remember back in March, at least I know I do, this was scarred on me, we saw a significant loss in the S&P 500 of almost 30% in a few days, in just a mere few days. That was called a correction. But what's interesting, what we have found is that the market will rebound to an all-time high typically within 10 months. And you know what? If you look at the market today, that's exactly what has happened. Now, what if the market goes into what's called a bear market? And a bear market is a prolonged time period when the market is performing extremely poorly. Well, we find that within 24 months, 2 years, the market has rebounded and again has reached all-time highs. So why is this important? It's important because you need to stay the course. Don't let these things scare you. And also know that the market, the stock market, is not necessarily your portfolio. We're going to go through putting together your portfolio that has not only stocks that go like this and this, but also bonds that are very nice and move slowly over time and increase in value. And I included this next slide because I think it's so powerful. There's a lot of data, but what I just want you to look at is that beautiful purple color, that big bar out there. And you see next to it $623,127. What is that? Well, that's the amount of money that you would have in your pocket if you had invested $10,000 in the S&P 500 and you had let it sit there from 1979 through 2020. That's phenomenal. I mean, I don't even know, it's not doubling, tripling, quadrupling, it's many times over that. And it's not adding 10,000 each year, it's just putting that money in and letting it work. But what I want to show you, do you see the number right below that? That 289,000, nice number, but it's, more than half less than what we would have gotten if we were fully invested. Well, these poor people decided they were going to be market timers. And they pulled out of the market when there was a big loss, like we saw in March. And they didn't put their money back in. And they missed the 10 best trading days of that time period. And you can see those that missed the top 50 best trading days. So these are people that would be putting their money in the market, taking it out when the market goes down, putting it back in. Well, they only have $50,000. So the story is, don't do all that work. Put your money in the market and let it grow. It's going to be going up, and there will be, unfortunately, times that it goes down. But 3 out of every 4 years, the market goes up. So if you fancy yourself as what we call market timer, someone who puts their money in and takes it out, I have to tell you, long term, you're going to see your returns much, much, much more reduced. So what's going to happen to the market? What's going to happen in the future? We don't know that. Even the best analysts that live and breathe the stock market every single day don't know the answer to that and don't have a crystal ball. So making sure that your money is working for you is really important. The last thing you want to do is to make big decisions when you're scared, when you're frightened. So what happens, though, if you yourself right now are looking to retire? Should you change your portfolio? How should you prepare? Well, as we get closer to retirement, if the market goes down, don't panic. Just write it out. Know what cash you need immediately. Reassess your risks so that when the market comes back up, you can tweak your portfolio to be maybe more conservative. And know that if you're starting to live on your portfolio to replace your paycheck from a job, that you're not going to take everything out over time. In fact, what's really key, and I love this, Alicia Manel said this, you don't need 100% of your money out of your portfolio the first month of retirement. And if, God forbid, the market takes a big dive the first month of your retirement, make sure that you have both stocks and bonds, because your bonds are not going to go down in value. In fact, they might even go up in value. So where would you take your money from for your paycheck that first month of retirement? Well, you're going to take it from the bonds, because you're not going to want to touch the stocks and sell the stocks and lock in those losses. So again, don't panic, write it out. And we're going to talk about how to create that beautifully balanced portfolio so that when one part of your portfolio might be going down, another part is definitely going to be either holding its weight or going up. So if you are behind in your savings, there are things that you can do. And for a lot of people who wanted to retire in a few years, they're actually finding themselves needing to retire now. The unemployment rate is still double digits, and many of these individuals realize that retirement is now their future. So what they can do is they can maybe freelance, downsize their home, possibly move to a less expensive part of the country, be able to look at their spending patterns and be able to reduce their spending. These are all things that you can do to maximize the financial stability that you have and not have to take too much out of your portfolio if you don't have the income you need and you're having to retire sooner than later. So how do we get there? Well, it's choosing the right stocks and bonds. And I love this cart because you can see there are so many different things in it. Well, that's what a portfolio should do too. You shouldn't have all your eggs in one basket. In fact, in your portfolio, you should have U.S. stocks. You should have some bonds. And you should have a little cash. Now, that might be a little, I don't know what you would say. You may wonder why you would have cash. You're not going to have a lot of cash, but if you are taking distributions from your portfolio to live on, well, having cash to be able to fall back on if things go down in your portfolio will be important and key. Often we typically tell people they should have about 2 or maybe 3% of their money in cash if they are living on their portfolio. And then I wanted to show this other one, because this is the one that many of us ladies forget. I know I love to travel, and I remember traveling to Paris, I remember traveling to England, and I'm sure you each have a favorite destination that you've traveled, and we'll get back there. But international stocks, we're great about traveling internationally and wanting to explore the world, but we forget it when it comes to our portfolio. International stocks are really important and key. In fact, the highest performing asset last year was what's called emerging market stocks. They're stocks from countries like China, South Africa, Russia, and several others. Here are some great examples. So large company stocks, Google, Amazon, Disney, Goldman Sachs, smaller companies, and I love this one, Steve Madden. I love Steve Madden's shoes. But international, so developed international are countries like I just mentioned, France, the UK, Australia, Europe, Canada, and emerging markets are China, Brazil, and South Africa. And you want a little bit of all of these. Okay, I get it. This looks like a patchwork quilt of someone who is not color coordinated. It's a little hard to see. But what I did include was this little line, and it's connecting a certain asset class. Well, this is a portfolio that is 60% in stocks and 40% in bonds. And you can see how it performed. Now, it's never a top performer, but it's also never in the very, very bottom. And so let me show you an example of an asset class that is really quite risky, that you only want to make sure you have a little bit of. Well, that's emerging markets. And like I said, emerging markets did fabulous last year in 2020, but that hasn't been always the case. You can see it in purple here in 2004 and 2005 did great. You can see it's at the top, outperforming any of the other asset classes, doing better than large company stocks here in the U.S., doing better than small company stocks here in the U.S. But look at this. They had a 53% drop in value in 2008. Then they came back up in 2009, were the top performing, and then they were back down in 2011. You can see it looks like someone is having kind of, I guess, maybe a heart attack. So that's why you would not want to put all your money in just emerging market stocks. And the other thing that this tells us is that we can't really tell what's going to happen. I mean, yes, we had 2 good years here, and this one wasn't bad, this one wasn't bad, but then emerging markets absolutely plummeted. There's no particular rhyme or reason why one asset class is doing better than another. So that's why it's much better to, again, have that 60% in stocks, 40% in bonds. What's right for you? Well, if you're younger, maybe you have more in stocks. Instead of 60%, it might be even as high as 80%. But if you're nearing retirement, maybe instead of 60% in stocks, you could only have, let's say, 50%. I talked to a lovely lady today who's in her late 80s that we're working with, and she has actually a total of only 20% in stock because she's super conservative. So again, choose what's right for you. And we're going to actually show you a couple different questionnaires you can use to figure out, number one, what's right for you based on your retirement, but also what's going to let you sleep at night. And this goes to the question, what kind of risk can you handle? And most people think they can handle more risk than they actually can. And a good example is that when someone is making money in the stock market, they tend to feel like they can handle risk very well. But that same person, when they have a loss in the stock market, all of a sudden they realize that they may not be able to handle that risk as well as they thought. So I wanted to show you this portfolio all the way over here on right. And it's in bright red. Well, there's a reason it's in bright red, because it's ultra aggressive. Essentially, this portfolio has 100% of its money in stocks. And we tracked this portfolio from 1926 all the way through to like 2013 and looked at how has it performed. Well, on average, you can see it was the top performing. It was over 10% each year, 10.2%. I think we would all be very happy with that. But I also want to show you there were some years that it lost 43%, right? And so what would you feel comfortable with? And I know these percentages may not say something to you, but assume you had $100,000 in your portfolio, in your 401k, and all of a sudden you saw $43,000 disappear, almost half of it. How would you feel? Right? So that helps you, again, identify what your risk tolerance is. When you actually map it to dollars and say, how would I feel if I lost that? That's going to tell you what kind of investor you need to be. So this is a asset allocation quiz calculator, and I know that I had mentioned this before. The URL is right down here. It's on Money magazine. It's through CNN. So take a look at that, write that down. You can also do a screenshot. I know I like to use my phone, and I do a screenshot as well. But what's wonderful is it's going to ask you when you need to tap your portfolio, aka when you're retired, when you're not taking any income, how much risk you can handle. It's going to ask you that as well. It's going to talk to you about when the market drops, have you ever sold your account because you were scared? Like things like that. And it's going to be very helpful for you to, again, know what your risk is. And then look at this. It calculates for you, based on that, what your ideal asset allocation is and what percent in large company stocks, what percent in foreign stocks, what percent in small company stocks, and what percent in bonds. And so as we see this right here, this lady, she is pretty young. And she is taking on a lot of risk, but it sounds like she can handle it, and she's very comfortable. That may not be the case for you. So the next thing I want you to do, now that we know what our mixture between stocks and bonds is, I want you to understand how to research investments. It's not rocket science, and you can easily do this. So this is a sample of someone's 401k options. If you have a 401k, you have options that you can get from your HR department, and often you'll have a website you can log into. If you don't have a 401k and you have a brokerage account or an investment account, you can get this from your provider as well. So we're going to take a look at one of the holdings. and that is the Transamerica Partners. We're just looking at it to see what it is. And actually, when I looked at this, I had no clue if it was even a good holding or not. But I did our research. And the first thing I looked at was, what is it? And you can see that it's large company U.S. stocks. Tells you right there. It also tells me the Morningstar rating. And I want you to know that the Morningstar rating is 0 to 5. It's like going to a 5-star restaurant, 5-star being the best. Well, it only has 2 stars. So I will tell you, so far, I'm really not impressed with that. The next thing that we're going to look at is, how does it compare to other funds that invest in large company stocks, just like this fund? Well, if you take a look, this 90, that's not a good number. That means it's in the 90th percentile. That means that it's essentially really not so great. It's been outperformed by 90% of its peers. I don't know about you, but I'm not so impressed with this. There are other things I looked at in it, and you can see, yes, it's large company stocks. It's 99% company stocks, large company stocks that are here in the U.S. Non-U.S. stock, that's a fancy way of just saying foreign or international, has 0, which is fine. But it's important to see what's in there, because there are some mutual fund and exchange-traded fund names that don't really tell you what's in there. It's kind of like when you buy a car, you don't really know what the engine is until you look at it. It's almost kind of like if you see another woman walking down the street with her handbag, you may have the same handbag, but you don't really know what's in her handbag. So this lets you really see what's in it, so you know what you're invested in. And then this tells you how many stocks are in it. So in this mutual fund, it holds 118 stocks. And that's actually kind of a small number of stocks. The exchange-traded funds or mutual funds that invest in the S&P 500, for example, hold 500 stocks. And those are the 500 largest stocks in on the stock market. And then we have the expense ratio. This is important and key. What are you paying to the mutual fund manager? And here you can see you're paying almost 1%. So it means that whatever your returns are, well, they're 1% less than you would get if you because of this fee. 1% is actually a okay fee, but I will tell you that there are many wonderful mutual funds and exchange-traded funds where the fees are half of that. In fact, Vanguard, their fees are often like 0.2. The higher the fees, the harder it is to outperform long-term. Now, the next one I want to take a look at is this one right here. So this is what's called a target date fund, a lifestyle fund. And the way that this works is that this mutual fund over time becomes more and more conservative, so that by the time 2050 comes, it's going to be primarily bonds, because it expects that that's when you're going to retire. So the way that you use these is it's a wonderful way where you can pick which one of these might be closest to your estimated retirement date, and then they do all the work for you. I have to say I like that. So you can look up here the T. Rowe Price 2050 Fund Morningstar. So I'm actually showing you how to do this. You then click on that, and guess what? This is where we get the information. You can do that for any fund. And look at this. I am happy already. It has a 5 out of 5 star. I'm liking that. Look, it has no load. You're not going to have to pay a commission to buy this. That's great. 100% of your money is going to go in. The expense ratio, the last one was almost 1%. Well, this one is about a fourth less, so less expensive. So very happy about all of those things. So how has it done versus its peers? This is where the rubber hits the road. And do you remember that last one where 90% of its peers outperformed it? Well, you can see that, let's go back. You can see that it's done phenomenally well. So in 2018, only 24% of its peers outperformed it. 2017, it was 12%. 2015 was a phenomenal year. It was one of the best, nearly. So these are, again, wonderful ways that you can look this up. And the website you're going to go to is called morningstar.com. And you can get all of this information free of charge. If you want to pay a monthly fee, we pay a lot to get even more analytics, but the monthly fee is actually pretty reasonable if you wanted even more analytics and, let's say, research reports and analyst recommendations. Now, the other thing, do you remember how we saw on that last large company stock fund, it was 100% U.S. stock? Well, this is interesting. We're going under the hood of this one, and you can see that it's a very well-balanced portfolio for you. In just having this one mutual fund, you have it beautifully divvied up between U.S. stocks, 55%, foreign stocks, 31%, bonds, 11%, and a little bit of cash. So really beautiful. This is I hate to say set it and forget it, but a little bit like that. And what's going to happen is that these U.S. stocks, the amount of money in there, that percent will come down over time. And the amount of money in these bonds, that 11%, is going to go up over time. Because bonds are more conservative and have less risk. And so as you get closer to retirement, you need more and more of those bonds. So let's talk a little bit about things to be thinking about. The first thing is that you can have analysis paralysis. There's so much data out there, and I will be honest and very open with you. I find it can be overwhelming. We research thousands of different mutual funds and exchange-traded funds, and we're very fortunate that we have wonderful software that helps us along the way. And you don't necessarily have access to that software, but you do have access to Morningstar. So I wanted to show you the 5 most important things that you need to be looking at when you are researching mutual funds and exchange-traded funds. First off, the overall asset allocation. So what's it invested in? Is it invested in large company stocks or small company stocks? Is it in bonds? Is it invested in foreign stocks? That's the number one thing. What's it invested in? Number 2, choose a good mutual fund that has low fees and has no commissions, meaning that it's no load. And you can see that right on that Morningstar report. When in doubt, use one of those wonderful target date funds that we just looked at, where it's kind of a set it and forget it. When it comes to those stars, we require that it has a minimum of 3 Morningstar stars out of 5. Any less than 3 stars, a 1 or a 2, makes me nervous. And then the fund rank percentile. You're going to see that some years it's going to perform better versus its peers, and some years it's going to perform worse. But ideally, it should be in the top 50. So that number should be anywhere from 1 to 50. If you see long term that it's been 70, 80, 90, outperformed by 90% of its peers, as we saw in that first example, most likely it's not going to be something that you want to invest in. So I know that we went through a lot of information, and so just opening it up to any questions you have. And I see one question right now. I talk about an exchange-traded fund, and they asked, what is an ETF? So an ETF is just the, what it stands for, exchange-traded funds. And the difference between an exchange-traded fund and a mutual fund is not that big. They're both baskets. They both can hold any type of stock or bond. But what's different is that an exchange-traded fund, if I wanted to go on the internet right now and buy one, I would be able to have it in my pocket, purchased in my account within 30 seconds. And it gives me the price I pay the price that it's trading at on the stock market right at that moment. Mutual funds are a little bit different. So I could go and I could buy a mutual fund, but it's not going to go into my account till 4 o'clock until the market closes. And I'm not going to really know what the price I'm going to pay. The price I'm going to pay is the price that when the market closes, what it was trading at that time. They're both excellent, and they both are very appropriate for you. They just work a little different. We do find that exchange-traded funds, ETFs, do have lower costs, lower expenses in there. So there is definitely some upside to ETFs as well. Great.
Thanks, Stacy. And I see we have a few more questions, which I can read to you. The next one is saying you mentioned it might be a good idea to refinance your mortgage to get a lower interest rate. But with all the refinance fees involved, does it make more sense to refinance or to make extra payments towards the principal when you're able to with your current interest rate?
Boy, that is such a good question. It's a very good question. So this is how you can look at it. If you have a mortgage that is above 3% and you have maybe 5 more years on it, 10 more years, 15 years, or 20 or even more, it's going to make sense to refinance because you have a longer time period on that loan. And it means that the payments that you do make are going to be lower. Now, the question about what should you do with that money that instead of using it to pay down your mortgage more quickly, I would recommend that you then invest that and put that in your IRA or your 401k. And this is the reason why. If you're able to get a mortgage at 3%, then it's better not to make those extra payments. It's better to take those payments and actually invest them in the stock market. The stock market, as we saw in that one situation, returned on average 10% each year. Now, a 60% stock, 40% bond portfolio is not going to have 10% a year. But most likely, you're going to get anywhere from 5 to 6%. So let's say you're earning 6% in the market on that money, and you're paying only 3% on the mortgage. Well, you're earning 3% more than you normally would because instead of paying down that mortgage and that money essentially not working for you and saving there, you're earning 6%. So you're actually 3% higher. And again, I know this is a little complicated, but again, if we have $100 and we have the choice of pay down our mortgage at 3% or invest that $100 in the market, if we invest the $100 in the market, we'll get roughly over time a 6% return, which is a lot better than essentially the 3% that we have to pay in interest. So again, getting your money working for you in the market is the best. However, if it's, let's say, credit card, and the credit card is at 7% interest, then that $100 that we just invested in the market, I would say don't do that. Take that $100 and pay down that credit card because you're not guaranteed a return of 7% in the market, in the stock market, right? And so that's the essential question that you need to ask yourself. What am I paying in interest, and will I be able to get a higher return in the stock market? Really good question.
Mm-hmm. Okay, thank you, Stacy. Another question for you is asking if it's possible to still file for unemployment beyond the first week after becoming unemployed. I'm in my second week of being out of work.
Great question. Yes, you can file retroactively. And so even if it's been a few months, the reason why we want you to file sooner is that so that you can start to get that income flow so it's not quite as hard on you. But you can go and you can file, and when you go to the unemployment website, you'll put the date that you were furloughed, your last date of employment. And they will then pay you retroactively back to that date. Make sure that you are checking, because I have seen seen quite a few errors as well. So just make sure it's going to tell you what you're entitled to, and make sure that you get, number one, the back payments, but also the payments going forward. If you get severance, severance typically will disqualify you for a period of time. So if you have, let's say, 2 months severance, then if you're receiving that income over those 2 months, unemployment will not kick in and pay you until your severance payments stop. But then, of course, do file to make sure that you're getting unemployment from then on.
Mm-hmm. Okay, thank you very much. Another question is asking, if I go through a divorce and I get half of my husband's 401k, do I have to keep the allocations the way he had it, or can I change the allocation?
Yes. So when you are done with your divorce and the 401k gets divided and comes to you, it takes a little bit of time, because your divorce lawyer is going to have to do what's called a quadro, Qualified Domestic Relations Order. They file it with your husband's employer, a judge approves it, and then finally you get your money, and it will roll over to an account in your name in what's called an IRA. Once you have that IRA, the world is your oyster. That is your money, and you can invest it any way you want. We do find that a lot of women, the way that they were invested when they were married needs to be a little different now that they're on their own. So essentially, looking at mixture of stocks and bonds will be key, really key.
Mm-hmm. Okay, Stacy, if you have time for a few more questions, we have a few more. Okay, this next one says, when deciding to invest in big U.S. companies, am I able to select which companies in which I'd like to invest, or do I invest in the general category of big U.S. companies and my money is distributed among all in that category?
Yes, it's the latter. So if you're using a mutual fund or an exchange-traded fund, you're essentially hiring the mutual fund manager that runs that fund to make those decisions for you. So the one that we looked at, and I'll show you right here. So this one right here that we looked at, it's large company stocks. The mutual fund manager, and it's not on this page, but it actually gives you his name. And the reason why I say his is because unfortunately almost all of them are men. He is going in and saying, okay, we want Yahoo, we want Google, we want Microsoft, but we don't want Procter & Gamble. And so this fee that we saw on the next page, that 0.97%, that 1% that you're paying to that company and that mutual fund manager for doing that work. Now, you can open up your own account. You can open up an account just in your name, and you can buy individual stocks. And we have people that often will do this. They'll invest in mutual funds, the bulk of their money, but they'll have what we call fund funds. And a fund might be where you decide to invest in your favorite stock. Maybe it's Tiffany stock. Maybe it is Tesla. And the one thing I would do is just make sure that you do research. Morningstar has the exact same information available on individual stocks too, so you can do individual stock research on Morningstar as well. I will tell you that's not my area of expertise, individual stock research. There are people that live and breathe and eat individual stocks for breakfast, and I give them so much credit. For me, there's just not enough time in the day to know everything about ETFs and mutual funds and individual stocks. But there are advisors, too, that have a specialty in individual stocks that could also help you.
Mm-hmm. Okay. Stacy, another question for you is asking about recently rolling 401k to a Roth IRA. Would it be best to invest all into the Roth or split meaning half into the Roth and other half into an index?
So a Roth IRA is a vehicle. It's an IRA. It's a retirement account that when you take the money out, whatever it grows to, it's tax-free. It's beautiful. And so if you had a 401k that was called a Roth 401k, you then can roll over to a Roth IRA. You can invest in that Roth IRA any way you want. You can have stocks, you can have bonds, but typically what we do is we actually try to invest in a Roth IRA the asset that we think is going to grow the fastest over time. And the reason we do that is that we know whatever it grows to is going to be tax-free. So it's kind of like a balloon. Like you want that balloon to get as big as possible because you know you don't have to pay taxes on it. So often what we'll do with a Roth IRA is we might have something like small company stock, which grows much faster over time, emerging markets, which grows much faster over time. And then the other accounts you might have that are not Roth IRAs, you might invest in bonds to offset some of that risk, or large company stocks to offset some of that risk. If you have the option of investing in a Roth 401k or a regular 401k, a lot of employers offer that now. What we encourage people to do is to do half and half. So invest half of your contribution each month to the regular and half to the Roth. And that's because it hedges your bets. You'll have one where you're taxed on the money when you take it out, but now you get a big tax deduction. And the other, there's no tax deduction or benefit right now with the Roth 401k, but when you take out, it's tax-free. So typically we just recommend half and half.
Mm-hmm. Okay, great. Thank you, Stacy. I see we're about out of time for questions, so I want to thank you, Stacy, for presenting today and sharing a lot of helpful information. Again, we'll be sending this recording to everyone. And Stacy, I just want to highlight a comment here that says, "Thank you, Stacy, for this workshop. It was a nice review for me and helps me prioritize what I need to do for this year." So I just wanted to share that with you. And I want to thank everyone for joining us today, and thank you again so much, Stacy.
Great, thank you. And if anyone has individual questions about your situation and your portfolio, visit the Savvy Ladies website. That's what our financial helpline is for. And we'll connect you with a certified financial planner, investment expert, to be able to bounce some ideas off. So please use the helpline. It's there, it's free, and it's for you. And thank you for support. And thank you, Maggie.
Thank you. Bye-bye, everybody.
Bye-bye.